next. Let's get more with Dr. Stephen Nash from FIIG Securities. Warm welcome into the show as always. Really, we've been talking global headwinds, one factor to consider, but it all seems to come back, does it not, to that core inflation watchword that the Reserve does have to grapple with.
Look, yeah, Carson, we've had a series of weaker than expected numbers with regard to confidence readings, with regard to credit growth and other measures. So it really depends on what the RBA wants to focus on, whether they acknowledge these changes in the global scene or they focus also on the weaker numbers here. But we've had 10-year bonds trading very close to 5% yesterday, trading down to about 5.04, so we're getting very close to that 5% level. Any dovish minutes here will get that bond rallying through the 5% level. Again, another key indicator here. Again, 3-year bonds trading very low, very close to cash right now. So bond markets aren't pricing much in at all in terms of tightenings.
It's very interesting, though, that Governor Stevens only last week was doing the opposite of sounding dovish. He sounded quite hawkish on it. So from that, and given that he does have that casting vote, as it were, are you expecting a dovish statement? What would allow that?
Look, the market seems to be pricing that in, but I'd imagine that, as Stevens has said repeatedly, that they're definitely on the tightening bias. It's a question of when they judge it appropriate to tighten. I think they'll need the inflation readings in July before they go in August. However, that really all depends on what's going on globally at that time. Now, we've got a series of things we're looking at right now. We've got TEPCO in Japan affecting ratings there. We've got the European debt crisis, and we've also got the US debt ceiling. I mean, we've got a series of very important global factors. So we really have to wait for the outcome of some of those. Yeah.
Well, it's interesting. You touch on the US debt conundrum. You're saying that's a bigger fish to fry than Greece.
Potentially, this US debt ceiling could be very important for US debt markets. Obviously, US debt markets are the most important benchmark in the world. We don't expect that there will be a default there, but still no agreement. We've got another hard month of negotiating to go through. We've got the deadline early August, so we're running out of time there. I think also the rating agencies have given the US government a limited amount of time to get their fiscal position in order. So that, again, I think the focus on the ceiling is probably the wrong one to have. The focus probably should be on reducing that deficit and maintaining the credit rating there.
I was going to ask you, what does it then come down to? Is it spending cuts? What primarily will be the push on for reform on the Hill?
Well, the problem, I think, is for the Republicans who are opposed to any taxation increases, and I think the Democrats are trying to push for those as a way to reduce the deficit. I imagine also, given the recent reduction in growth, that there'll be opposition to severe spending cuts. So I suppose the recent growth puts the ball back in the Republicans' court, and they may have to accept some of these taxation increases.
There's interesting developments across the pond, across the Atlantic, with the UK and their own Fiscal Studies Institute, looking at some of the winners and losers from elevated inflation, and yet realistically it's a one-size-fits-all approach when it comes to tightening, right?
Look, I think it's a very interesting study. What's been happening in the UK is they've had elevated inflation with very low growth. Now, you'd normally think, well, that affects everyone equally, but the study shows graphically that lower income groups are really affected by increases in essential items like food and fuel. So effectively there's a series of inflation rates, and those who can least afford it are hit hardest by increases in food and fuel.
Isn't the problem, though, Dr. Nash, that those are the very same measures that are stripped out of any core inflation reading? So they're cast to one side. They're deemed, if anything, too volatile, too toppy, and therefore not to be judged on.
Well, that's exactly right. So that situation could occur in the Australian situation. We have core inflation control, but headline elevated, and that's really going to affect a lot of low-income family budgets. We've seen some of those readings in the Westpac Consumer Confidence Index where family finance is at a very low level. So food and fuel is really affecting a lot of families right now.
It's interesting, though, that just over the weekend, the IMF, the International Monetary Fund, came out and, if anything, revised its growth projections on key regions, and it stuck to its call on China. So notwithstanding a weaker consumer here, again, the multi-layered economy, is it the case that that's the pain you've got to experience to keep the Chinese growth story alive?
Well, we have seen readings of Chinese inflation being quite high, and that was interpreted as being positive for markets. I think, if anything, the Chinese authorities really have to clamp down on that, and that's, I imagine that the growth will moderate there. That's not to say that they're going to have a recession. It just means lower growth. So we could expect a step down in growth, and I think that's a real positive for RBA policy.
Speaking of growth, the Fed in the US meeting, well, in just a few hours' time, what will their growth snapshot be? What will their takeout on the current situation come down to?
I'd imagine they'll be acknowledging a little bit of a step down in growth there. There may be some comments about what happens after QE2. I expect that it's probably a little bit early for that, but there could be some questions from Bernanke about that. We have the press conference. I imagine that the acknowledgement of weaker growth will be something that the markets will be looking for. You've obviously got US rates already very low, under that 3% level, but I think the reason for US rates to stay there will be determined in terms of what's going on with equities, and I'd imagine that will be really dependent on what happens in Greece at the moment. That's really the chain of events.
They'll be obliged, will they not, though, to flag jobs. There is that dual mandate the Fed does have to handle. Where is the job creation?
Well, that's a real problem for them right now. Unemployment being as high as it is, I imagine that monetary policy will be set at an unchanged level for quite a while. I think they'll probably emphasise that monetary policy will remain unchanged for an extended period once more, and that may give Treasury markets a little bit of an impetus to rally a bit further through towards the 2 3/4 level.
It's very interesting, just a call from Soc Gen saying when it comes to crude, and we know elevated prices there at the Bowser mean a more reluctant US consumer. They say the risks on price action are to the downside. So that could be some momentary relief in sight for US consumers. Dr. Nash, thank you.
Thank you very much. Thanks.
Stephen Nash from